안녕하세요. 연합인포맥스 투자금융부 서영태 기자입니다. 오늘은 미 사모펀드 운용사인 아담스 스트리트 파트너스 제프 에이커스 세컨더리 비즈니스를 담당하시는 분이죠. 스튜디오에 모시고 인터뷰 나눠보도록 하겠습니다. It's a pleasure to meet you. Thank you for joining us. Would you please tell us about yourself and Adam Street Partners? I want to know about the history, assets and records, things like that. Yeah.
Okay. My name's Jeff Akers. I lead the secondary investment team at Adam Street Partners. I've been at the firm now for 18 years.
18 years. Wow.
And I've led the team for the last 8 years and serve on the executive committee of the firm. I chair our investment committee for secondary investments. Adam Street is a global private markets manager. We manage about $60 billion globally.
Wow.
We have 12 offices. And we have over 600 clients around the world that we're investing on behalf, institutional clients. We have 5 investment strategies that we invest from. We make primary investments where we're investing in private equity funds when they first get raised. We make secondary investments, the team I lead, where we're buying into funds after they've already been formed and we're replacing an existing limited partner in the fund. We do private equity co-investments where we're investing alongside our favorite buyout sponsors as we're looking at as they're looking at deals and need additional capacity beyond what they can put in their funds. We have a private credit capability where we're investing in middle market leveraged buyout loans, and then we have a growth equity team that's investing directly into high growth technology and healthcare businesses. And so we've been around for over 50 years now. I think really our strength and resilience over time has been based on delivering great returns for our investors. We've outperformed the PME consistently across all of our investment strategies. We are employee-owned, so there's a lot of collaboration across the various investment teams, which I think has been a really important driver of our business over time. We've been in Korea since 2017, and we now have 35 clients in Korea and have developed a really nice presence and relationships in the market. So very happy to be here.
Oh, yeah. I'm very happy to meet you too. So my question is that when I meet Korean pension funds and insurance companies, the sources working at there, they say they want to expand alternative investments, including private equity, growth equity, private credits, things, the investments you mentioned. So would you explain about the global trend of the market for the Korean investors, please?
Yeah. Well, I think, there's probably 3 high-level trends that come to mind. First and foremost, private equity has delivered very strong and stable returns in a market of volatility over the last several years. That's kind of, I think, the promise that we give to our investors is there's an illiquidity in our marketplace, and so we're going to deliver excess return relative to public markets. But we have been investing in a period with a pandemic and supply chain issues, labor issues, higher interest rates, and all those things have put pressure on all markets in the world. And I think private equity has been very resilient and delivered strong returns throughout that time. So number 1, delivered great returns. Number 2, and I think it's part of the reason private equity has been resilient, has been private equity. Many people think about it as an asset strategy that's heavily based upon leverage and one where a lot of financial engineering is driving return. And as the private equity market has evolved, our view is it's very much a market about driving operational improvement at companies. And the funds that we're investing in, particularly in the lower middle market, have invested heavily in identifying the most resilient businesses and then bringing operational talent to help grow those businesses, make them more efficient, improve margins. If you just look at our secondary portfolio that we're invested in, that portfolio growing 14% on average, mid 20% EBITDA margins, with that improving 120 basis points over the last 12 months, and very limited leverage. And I think as we think about the resiliency of the asset class, that's a big part of it. We also think private equity has a very attractive governance structure, which allows people to think about generating returns, not sort of producing profits next quarter and making profit maximizing decisions over the short term, but really much more about over the course of a 5-year private equity hold, how can we maximize value? And that's, I think, allowed it to outperform other parts of the market. The last trend I'll mention is maybe a little bit of a negative trend, which is that we've seen lower levels of liquidity coming out of private equity funds over the last several years. And that's been a function of higher interest rates. We've seen the M&A market really slow down. We've seen the IPO window close. And so it has investors clamoring for liquidity. Now, I invest in the secondary market. It's been a net benefit for us in what we're doing, in the sense that we are a source of liquidity in the private equity market. And so we're seeing significant deal flow in our market, and we're seeing a lot of growth in GP-led continuation vehicles where GPs are trying to generate liquidity in their funds. So those are some of the, I think, major trends that we're seeing in the market today.
So when you run your secondary business, you see mass opportunities, right? But the secondary investments are a relatively unfamiliar concept, I think, in Korea. So why secondary funds? Why do we have to invest in secondary funds? And could you give us more details about the global trends and what is the prospect and what do you expect from the market?
Yeah. So I just think if you take a step back, why do investors like secondary funds? There's really three things that we think about and real advantages of coming into a fund later in its life. First, we're typically buying assets at a discount to NAV or ahead of a valuation inflection point. So we're producing immediate gains, which is different than a lot of the private equity market where there's a J curve initially, a negative return early on in a fund's life. We're offsetting that and creating early gains. We're coming into a fund later in its life, so we're closer to a point of liquidity. It's a shorter duration form of private equity. So investors are concerned about liquidity today. Secondaries are a good place to invest because that velocity of capital back to you is faster. Our typical payback period on an investment is about 3 years versus traditional private equity where it might be 5, 6, 7 years. And then lower risk profile. Our portfolio is very well diversified. We don't have any real concentration risk by company, manager, sector. And again, because we're underwriting assets that are closer to their point of liquidity, they're more predictable and there's less risk because of that. So secondaries, as a result of all those things, have these very favorable cash flow characteristics and have generated very good risk-adjusted returns over time. If you think about the market opportunity today, we think it's particularly compelling time. It's probably the most attractive market fundamentals that we've seen since I've been at Adams Street over the last 18 years. We're seeing tremendous supply of new transactions. That's as a result of the amount of primary fundraising that took place in the market over the last 5 to 10 years. That's generally been the best predictor of secondary flow over the next 5 to 10 years. So we see that, and when you have all that primary buildup of funds, and then you have a lower liquidity environment like we've been in, you have a lot of motivated sellers in the market that are looking to sell. So there's a lot of deals. We're expecting to see significant market growth. And what's interesting to us is we think the market's undercapitalized today from a buy side. So there's not enough capital to absorb all the deals that we see. And particularly in the lower middle market, sort of deals below $200 million, there's not a lot of buyers in that segment. A lot of capital has been raised by a handful of large mega funds. That's a more competitive space today, and we find that there's just less competition for smaller deals. So very compelling time to be investing. The last thing I'll just comment on is interest rates. Higher interest rates have been a general headwind for private equity. They've been a tailwind for our strategy. It means that buyers that are using a lot of leverage have had a higher borrowing cost. We're not heavy users of leverage, and as a result of that, our strategy has really been less impacted. And in fact, it's allowed us to really go in and buy the specific positions in the market that we're most interested in. So it's been a very favorable environment for the secondary market broadly, but especially our strategy.
So you are head of the secondary business in ASP, right? So
Yes.
I want to know about the advantage that ASP has as a secondary business, as a asset manager who runs secondary business. What is the advantage compared to other North American asset managers?
Yeah. I mean, so Adams Street's one of the most important allocators of primary capital in the world. Our firm is going to invest about $10 billion into the private equity market this year. That's our plan. And a lot of that's into primary commitments to private equity funds. And because of our influence as an LPAC member on over 500 funds and an important reference investor, GPs are looking for ways to strengthen their relationship with Adams Street. And co-investment, private credit, and secondary deal flow and access to their people to be able to do deep due diligence around funds is very important. These relationships that we have are very hard to replicate. They've been built over decades of us investing in the private equity asset class. And so we're in a very unique position to be able to find and perform due diligence on deals. Ultimately, our goal is to use those sourcing and diligence advantages to find less competitive deals where we can identify value and see those early gains and opportunities for near-term liquidity, and to lower the risk in our portfolio. And we, again, think that being able to access less competitive deal flow and really leverage our relationships in the market allow us to sort of deliver against those core secondary benefits that we talk about.
You mentioned that the higher interest rate environment is a tailwind for the secondary business. I want to know some more details about where we can find more value.
Yeah. Well, as the market's matured, there's different segments of the market that we have the option to invest in. And one of the areas that a lot of people think about is LP-led deals versus GP-led deals. And we've maintained a very flexible approach to be able to seek value at different points in time in the market. If you think back in late 2022, there was a lot of seller distress in the market as we saw an increase in interest rates, and the LP market presented a very interesting opportunity for us to buy from distressed sellers. Once we got into 2023, we started to see a very compelling opportunity to buy the best companies within our GPs through GP-led transactions at very attractive prices. And as we've sort of pivoted now into 2024, we've also seen another very strong opportunity as there's been sort of a little bit of pressure on pricing in the larger end of the market on LP deals to do more GP-led deals. The one, I think, common theme across time for us has been focusing on smaller transactions and focusing on smaller funds. And you mentioned interest rates. When there's higher borrowing costs, that puts a lot of pressure on strategies that are dependent upon leverage. And as I mentioned earlier, one of the real positives happened in the market over the last several years has been really operational improvement, helping companies grow more. And we find that the levers for growth, the levers for market inefficiency, and to drive efficiency in businesses has been more in that lower middle market, sub $5 billion funds. So that's been a real common theme for us. Probably where we found the most value in the market has been in smaller deals and in smaller private equity funds.
So I think that was my last question. I want to ask you if you have any more messages for audiences.
Yep, we're just very thankful for the support of the investor base that we have in Korea. Couldn't be really more excited about the market opportunity and our positioning in the market today. And I think it's going to be a very interesting vintage for the secondary market over the next couple of years.
Thank you. Thank you for the comments, and thank you for joining us today. Yeah.
Thank you.
Yeah.